We're back here in the corporate suite down in Houston. We actually just moved to a 3-bedroom, so we're moving up in the world. I'm here in the guest room, call it the podcast studio for now, but I had to move inside. It's just too hot outside. So today I wanted to talk about occupancy and the nuances there and some of the new things that we're implementing on that front. So as far as occupancy is concerned, it's kind of one of the first operating metrics that people look at. They want to see, oh, well, how's that deal performing? Well, what's the occupancy? Right? Is it 95? Is it 90? Is it below 90? Right? And that's a common demarcation, particularly for lenders, because lenders view stabilized property at around typically 90% occupied and above, or unstabilized properties at 90% and below. Obviously, there's some wiggle room there, but that's kind of the general idea. The other concept about occupancy is the way that it supposedly implies, like I said, the health and performance of a property, that if a property is at 90% occupancy, it is performing well. But of course, you have to look a layer deeper, and occupancy doesn't tell the full story, and it can really be just a vanity metric hiding problems beneath the surface. However, on the other hand, people sometimes use occupancy as a crutch, and they'll point to the average occupancy of a submarket and say, well, my property's at 88%, but look, the comps are on average 87%, so we're performing just fine, right? We're doing okay. And that's not true either, because the reality is depending on where you are, but most of the time, the property that you own and manage, there's enough of a tenant pool there for you to be 95% occupied. It just might not be at the prices that you want to be occupied. So now here's where we get into the gray area and we get into more of a philosophical conversation about what kind of manager do you want to be and how do you want your property to perform. For example, you can say, no, I'm going to be stubborn. I'm going to stick to my high rents and I'm okay with having a slightly lower occupancy because of it. Or you could take the opposite argument. You could say, you know what, I'll meet the market. I will lower my rents such that I will find an equilibrium where my occupancy can be comfortably at 95%. And I would argue that that's actually the better approach, and that's something that we are implementing as a culture throughout our company, is we want everyone to understand that 95% occupancy is the standard. It is a requirement. There's no excuse. There's no reason for any property to be below 95% occupied. Now, of course, in the short term, you might have situations with re-tenanting a property or a one-off occurrence that might cause a dip in occupancy, but by and large, the standard needs to be 95% occupancy because it's possible and because it's more beneficial for a community to be 95% full at lower rents than it is to have higher rents and to be less than 95% occupancy. Because again, those points of occupancy that you're losing, you're getting no rent whatsoever for those empty apartments. So I would rather have higher occupancy, slightly lower rents, and at least I'm getting something. And we're in a more comfortable, confident position to push rents from a 95% occupancy standpoint. Now, like everything, there's some nuances. So one interesting nuance is the fact that when it comes to getting financing and then how that relates to, of course, selling, you don't want to be above 95% occupancy. And this is kind of a paradox because you would think, well, if I'm selling a property or if I'm going to a lender and I'm looking for financing, shouldn't I seek to have the highest occupancy possible and to have the highest revenue possible? But the answer paradoxically is actually no, because lenders will not underwrite to an occupancy rate higher than 95. So you're just simply capped. So if you come to a lender and you say, hey, my deal's 100% occupied, they're going to say, that's great and all, but we're actually going to chop it down to 95% occupancy, and that's how we're going to calculate your income, and then that's how we're going to calculate how much debt we can give to the property via the LTV and DSCR. So that might not seem fair, but I think that's just conservative, normal lender underwriting. So the tricky situation becomes now when it comes to a lender's analysis, it may actually pay to have higher vacancy than, let's say, 97%. You might be better off being at 95 versus 97 because of that factor. You're getting discounted anyway on the vacancy. So you're better off actually pushing rents because the lender will give you full credit for the higher rents, but they'll still discount your occupancy down to 95. So when it comes to preparing a property for sale or for refi, that's where it can pay to more aggressively push rents to the detriment of occupancy. However, we're not looking to refi or to sell properties at all times, right? Most of the time, we're just simply owning and managing them on a monthly and quarterly basis and optimizing for cash flow and long-term value. Now, optimizing for long-term value is most certainly keeping the property as full as possible with high-quality tenants that turn your property from a property into a community. And that's where you really start to see the amazing effects of rent growth and low turnover. And those things really add up on the bottom line, because if you have renewing tenants that are paying more, you're able to get rent premiums without even spending any money on not just renovations, but turnover costs as well. You can, a turn can cost anywhere from $1,000 to even $5,000 for a very heavy turn, and renovations can cost $5,000 to $15,000. So if you can accomplish even just a flat renewal and you don't have to spend any money on a turn, you're ahead of the game right there. Now, obviously, when we're renewing rents, we're cognizant of the market, and if we can raise rents, we will like to do so. And if our business plan calls for unit renovations, then we're also comfortable with allowing that tenant to move out so we can renovate the unit and so we can get higher rents. But all these things need to be factored in, and understanding from a long-term value perspective, not just from a, hey, I want to get financed today, or I want to present the property for sale tomorrow. It's thinking long-term, how do we maximize enduring cash flow, and how do we really build something that is an amazing community?